All right, welcome back, everyone. Today we're taking a deep dive into the world of enterprise AI.
Specifically, the recent performance of C3.ai.
Exactly. You sent over some excerpts from their latest quarterly report.
The Form 10Q filed just recently, December 9th, 2024.
Right, for the period ending October 31st, 2024.
So we're going to unpack their financials.
See what risks they're facing and how their strategy is evolving.
Should be interesting. It's a company at a bit of a crossroads, would you say?
Oh, absolutely. I mean, their journey itself is fascinating.
Yeah, where they started.
From elastic cloud computing, remember that?
Back in 2009.
Then to energy management as C3 Energy.
Then C3 IoT, trying to broaden their reach.
And now C3.ai.
Front and center. That AI focus.
It's not just a name change, though.
No, it really reflects a whole shift in how they see themselves in the market.
Absolutely. It makes you wonder, all of these pivots, what's the driving force?
Is it just adaptability or something more?
Well, let's look at their Q2 2025 report because there's a big strategic shift.
Oh yeah, this consumption-based pricing.
Alongside their traditional subscription model.
That's a gamble.
Feels like it, right?
It mirrors a trend we're seeing, though.
Across software, yeah.
This move towards usage-based models.
But for C3.ai's customers, what's the impact?
Well, new customers, they pay based on their actual consumption.
Of vCPU hours, right?
Exactly. So more flexibility.
For those who don't need the whole subscription package.
But the downside for C3.ai, that predictable revenue stream,
That steady flow
it takes a hit.
makes forecasting tricky.
Much harder when you're relying on how much someone's using the platform.
So is this a sign of strength then? Or maybe a bit of desperation?
Tough to say. Their report does show revenue growth.
29% year over year, that's not bad.
Total revenue hitting $94.3 million for Q2 2025.
And subscription revenue, still their core,
86% of the total
going by 22%, and a chunk of that, 24% to be precise.
came from new customers, so they are expanding their reach.
But then we look at the RPO, the remaining performance obligations,
Which essentially tells us about future revenue from existing contracts.
and that's been up and down.
Like a roller coaster.
As of October 31st, 2024, it's at $260.5 million.
But that volatility, that's the thing that raises eyebrows.
Makes you wonder if the growth is sustainable.
It's a tough market.
Dynamic, you said it before.
AI software, things change rapidly,
And C3.ai has historically relied on a few big contracts.
which they acknowledge is a risk factor.
If they lose one of those big clients,
This could have a major impact.
so attracting new customers is key.
Absolutely. That's why we need to watch their pilot and trial count.
See how effectively they're bringing new clients in.
Exactly. Reducing their dependence on those few big players.
Trying to build a more stable foundation.
But those big contracts are still carrying a lot of weight.
And their focus remains on that subscription model.
No surprise there. It's been their bread and butter.
85% to 88% of their income over the past year.
Recurring revenue, that's what they want.
But it makes them vulnerable if those subscriptions churn.
That's the flip side.
But they're not just selling software, though.
Right. Their support services are a big part of it.
The center of excellence.
It's about building relationships with customers.
Helping them succeed with their AI implementation.
Absolutely. Fostering that long-term loyalty.
So it's more than just the tech.
It's the expertise, the hand-holding.
They're trying to create an ecosystem, aren't they?
Partnerships are key to that.
Working with big names like Baker Hughes, Booz Allen.
But also consulting firms, independent software vendors.
Building on the C3.ai platform.
They're trying to cover all the bases.
Smart because they can't do it all alone.
And competition is fierce.
Those tech giants with their deep pockets.
And agile startups popping up all the time.
So pressure on pricing, pressure on talent.
You need the best people to stay ahead in AI.
And that requires constant investment in R&D.
Can't afford to stand still. Innovation is nonstop.
So it's a balancing act. Growth versus spending.
And the legal stuff to navigate. Data privacy, security.
Huge concerns these days, constantly changing regulations.
One wrong step could be costly.
And they rely on those third-party services.
Cloud providers, other partners.
That adds vulnerability.
Changes in those relationships could impact their bottom line.
It's a complex web they're part of.
Interconnected, interdependent.
And the talent piece, attracting the best minds in AI.
Competing with the Googles, the Microsofts.
So their company culture, employee satisfaction, that's crucial.
Absolutely. A happy workforce is a competitive advantage.
And international expansion adds another layer of complexity.
Fluctuating currencies, different regulations, cultural differences.
A lot to handle.
So C3.ai operating in a dynamic and challenging landscape,
Lots of moving parts.
managing finances, navigating legal stuff, attracting talent.
And we haven't even dug into the specifics of their financials yet.
That's a whole other conversation.
All right, well, let's pause here for now. We've set the stage, listener. What stands out to you so far? What are you curious to explore further as we continue our deep dive?
Hold on to those thoughts. We'll be back in a moment to dissect their financial performance in more detail.
All right, welcome back. We just laid out the scene for C3.ai, how they've evolved, the strategies they're trying, and all those external pressures. Now let's zoom in on their financials. We talked about revenue growth, but there's more to it, right?
Always is, especially for a company growing this fast. One thing that jumps out is they're still operating at a loss.
Even with the revenue increases.
Yeah, the report shows a net loss of $128.8 million.
For the 6 months ending October 31st, 2024.
Makes you wonder, especially for investors, about their path to profitability.
So what's driving these losses? Just growing pains or something more fundamental?
It's a mix, to be honest. A lot of their expenses are tied to that aggressive growth strategy,
They're spending a lot on R&D, sales, marketing.
all essential for scaling up, grabbing market share.
But is it sustainable? That's the question.
The report breaks down those expenses, and sales and marketing are a big chunk.
How much are we talking?
$73.4 million in just 3 months.
The quarter ending October 31st, 2024.
That's a 21% increase compared to the same time last year.
Shows you how much they're pushing to build that brand awareness, acquire new customers.
It's a competitive market out there.
And R&D isn't far behind, is it?
Nope, $47.4 million in the same period.
Up 20% year over year. They're serious about staying ahead in AI innovation.
But it keeps those losses high for now.
A balancing act, right. Invest to compete, but those investments keep you in the red.
And that shift to consumption-based pricing adds another wrinkle.
Makes their revenue stream less predictable.
Exactly. Harder to say when they'll turn profitable.
A calculated risk, but more uncertainty for sure.
Which is why their efforts to control costs are so important.
The report mentioned some initiatives there, right?
Trying to optimize spending, personnel costs, data center expenses.
It's not just growth at any cost.
They're looking for efficiencies, managing resources carefully.
And leveraging partnerships to help manage those costs too.
Smart move. Think about cloud hosting, professional services.
Working with partners to share the burden.
It's a strategic approach.
So, multiple fronts. Internal spending, external partnerships, managing those growth investments.
And then there's the elephant in the room.
You mean the SEC litigation?
Yeah, that's a wild card that could really impact their financial health.
We mentioned it earlier, but it's worth revisiting.
Allegations of misrepresenting their partnership with Baker Hughes, their sales force.
Potentially misleading investors.
It's early stages, but an unfavorable ruling could be costly.
Financially, reputationally, it's a lot to deal with.
Adds another layer of risk to their prospects.
For sure. But let's look at something more positive. Their focus on ESG is increasing.
That's a big trend across industries these days.
Environmental, social, and governance issues.
For a company like C3.ai, dealing with data and AI, it's especially relevant.
They're under scrutiny, how they're using their tech, the impact it has.
And they acknowledge that in the report. They're trying to be proactive.
Not just lip service, they're taking concrete steps.
Integrating these principles into how they do business.
And it's not just about ethics, it's becoming a strategic advantage.
Investors, customers, they want to see companies that are responsible.
It's not optional anymore, it's a key differentiator.
So walking the walk, not just talking the talk.
And the report highlights some specific initiatives, right?
Reducing their environmental impact, promoting diversity and inclusion.
Ensuring their AI is developed and used ethically.
They're even looking at how their tech can tackle big societal challenges.
Climate change, healthcare disparities.
It's an interesting shift.
Not just internal ESG practices, but how they can be a force for good.
It's a powerful message.
For attracting talent, for resonating with customers and investors.
People who are looking for more than just profits.
So we've gone from the nitty-gritty of financials to this bigger picture of ESG.
It paints a more complete picture of C3.ai, wouldn't you say?
It does. They're dealing with tough financial realities, legal issues, trying to be leaders in a fast-changing industry. But they're also thinking about ethics, responsibility, social impact. It's a complex story.
Lots of questions to consider.
Exactly. And listener, as we head into the final part of our deep dive, we want to hear from you. What's resonated with you so far? What are you still pondering? Keep those thoughts in mind as we wrap up and explore the bigger implications of C3.ai's story. Welcome back for the final part of our C3.ai deep dive.
We've covered a lot of ground.
Their journey, their financials, those challenges.
So what's the big takeaway? What does this all mean for the world of enterprise AI?
C3.ai's story. It's complex, isn't it?
That's what strikes me. They're riding this wave of demand,
For enterprise AI solutions.
but headwinds everywhere.
Fierce competition.
Unpredictable revenues.
That legal battle looming.
And the pressure to innovate never stops.
That shift to consumption-based pricing. Perfect example.
Bold move. Could be brilliant.
Attract more customers.
Position them well for the future.
But also unpredictable.
Makes their financials even harder to decipher.
And speaking of financials, it's a mixed bag.
Revenue growth is there.
But those losses.
R&D, sales, marketing, they're spending a lot.
Classic growth phase dilemma.
How much to spend to fuel that growth?
How long can they stay in the red?
Then you've got the SEC litigation.
This adds a whole other layer of risk.
Distraction, potential financial hit, damage to their reputation.
Hard to see them achieving stability with that hanging over them.
But amidst all this, there's a bright spot.
Their focus on ESG, it's growing.
And it's not just about doing good, it's smart business these days.
Investors and customers demand it.
Ethical, sustainable practices.
C3.ai seems to be getting that.
They're taking action, not just words.
Integrating those principles into their operations.
Looking at their environmental footprint.
Promoting diversity and inclusion.
Making sure their AI is developed and used ethically.
Even exploring how their technology can solve bigger problems.
Climate change, healthcare disparities
It's a smart move.
could give them a real edge.
Aligns with what people want.
Companies with a purpose, not just profit.
So C3.ai, they're at a crossroads.
Lots to do to overcome these challenges.
And capitalize on the opportunities ahead.
But their story, it teaches us valuable lessons.
About enterprise AI as a whole.
Adaptability.
Strategic thinking.
Commitment to principles beyond the bottom line.
Because AI's potential isn't just technical.
It's about positive change in the world.
C3.ai's journey reminds us that the ethical, the societal impact.
Just as important as the algorithms themselves.
So, listener, as we wrap up this deep dive, one final thought.
If you were leading C3.ai, what would be your priority?
Double down on growth, even with the losses.
Focus on resolving that litigation. Clear the air.
Solidify their ESG strategy, attract those purpose-driven investors and customers.
No easy answers.
But the choices they make will shape their future.
Thanks for joining us on the deep dive. Keep exploring C3.ai's story and the ever-evolving world of enterprise AI.